What's going on? Chris here, and we're here to just try to understand what's going on in the markets. And if I were to kind of sum up in just a couple words what's going on, I think we're in like the no man's land of no man's land. Like, so what do I mean by that? So to make this a little bit easier, so this is the weekly, and I like to put a moving average channel to determine a no man's land. It's the, the in between trending and trend following strategies and mean reversion strategies. So like whenever this is when trend following works, and then this is when trend following ends and it stops working. And in between these zones, the probability is 50-50. And pretty much we're in that zone of the moving average channel between the two bands. It's basically no man's land. And it's either going to start trending or it's going to mean revert. It's going to get rejected. And so we're at a point where it's 50-50. And you could argue outside the bands you have a higher confidence of the direction it's going. So we could see right here that one version of the picture, the story. If we were to turn on the breaker, so this is the weekly breaker. This is a bullish breaker. So whenever it broke, this candle closed here on the weekly. It closed over this high and it broke bullish market structure. Here is a weekly bearish breaker with a retest inside it and then a resumption to the downside. And then now, just recently, about 3 weeks ago, 3 or 4 weeks ago, we've retested the breaker that we broke out of in November 30th, 2020. It took us a full 2 years to retest that area. So it's kind of come full circle, and we're like in the no man's land. So this is like the bigger version of the no man's land, and then this is even smaller version of the no man's land. And we could even see like the different levels to it. If we go, so that was the weekly, we're going to go to the daily, and you could almost say like it looks almost exactly the same. So this is a on the daily time frame, and I showed you basically the weekly, which is here. It's a lot bigger than no man's land here, and we could try to encapsulate just the area that weekly. So we'll put this as a gray here, and then we'll sync this and then move to the daily. So that is the no man's land, and then this is the no man's land of the no man's land. Because we're in between two breakers on the daily. So, fancy that. And I made a box for it. It's just this was more targeted within the moving average channel. I just wanted to show you just kind of how crazy and how confused people could be when we're kind of caught in between these two breakers. And we're caught between the two weekly breakers. We're caught between the two daily breakers. And guess what? It goes even deeper. We are caught in between two H4 breakers. We were between two H12 breakers, but that's over. That got purged on this one. So let me first just go over the H4, and then we'll kind of talk about the significance on what it did on the H12. So you could tell just by this is the no man's land of the weekly, And then this is now the no man's land of the daily with this box, and the moving average channel is roughly within this box as well. And then the H4 breaker to the downside here, and the bullish H4 breaker here to the upside is like the no man's land within the no man's land within the no man's land. So it's three standard deviations of no man's land in here, and three standard deviations of confusion. So that's how interesting this is. But we can still discern a bias or a direction or an idea of where it's going to go, both from our cheating forecasting software on math cycles, and on top of that, looking into events and then liquidity, where it's at, and just the range, but and how it's behaved so far, and that's hinting towards the H12. So in the H12, I remember that we went over. There was at one point there was two breakers. For some reason, it's not showing up. I guess it doesn't want to show up on the replay. But at one point, there was two breakers here. Let me see if it'll pop up. I don't know what happened to it. But at one point, there was two breakers. It was roughly, I think it's like around here or so. And now it's punched it out. And it kind of stacks from there. So even though we're in the no man's of the no man's land of the no man's land, we have a lean or a probability bias. Lean. It's leaning bullish. Without that's not without like a big pullback. So I think that's what's coming. I think we're gonna pull back pretty hard. I just don't know where it'll stop, but I'm thinking this low right here, we're gonna run it, and then we could even come down here. I have no idea. I got a average daily range here to really get an idea. Maybe the last week low. Maybe we run the last week low, but that's beside the point. I think previous week low right here, so we would run this low, and then maybe would wick back up. That's kind of just the only way I see that panning out for bullish, is we get below this low and we wick back up and reclaim all the way up here. But I've put a range on the H1. The H1 has developed a range, and the bias. I wanted to go on the bias really quick before we go into everything else. So this is the H12. The H12 hasn't changed bearish yet. It's been bullish. You can see from the white candle and that how things are going. And what has happened also in these no man's land is this thing called the H4 and H12 divergence. It's where the H12 is bullish, but then the H4 goes bearish. Like we saw the breaker right here in the tan box. That's the breaker. And that's kind of like a short time frame thing. And it usually happens near key events. And I think we're going into FOMC this Wednesday. And my guess of what's going to happen is that we cleared out this bearish breaker. So in effect, it looks like it's giving us a green light to the upside. Because in essence, the bears got stopped out. That's kind of what this breaker is all about. It's about a position of people who are leaning towards a certain bias, who are present in the market. And with the breaker gone, it is almost suggestive that they have been done away with. So that's one hint. is that the H12 is intact. We haven't all. Here's another thing: is that we haven't closed below on the day below the 8 EMA. So that's another thing that would indicate a lean bullishness. And then on top of that, if we talk about liquidity and the H4 order blocks, we got a couple bearish order blocks here where liquidity could be taken to really charge up the energy for the market to move strongly in a direction. So if it were to go down, there's not really a whole lot of liquidity that it can purge, but it could still gather a whole lot of demand by going lower. And I think that's what the banks are going to try to do. I think that's kind of basically what this H4 break was about, was that it was it's a near term long squeeze, and in a much bigger short squeeze. So that means we're gonna first go short for a little bit, maybe a pullback into here, and then short squeeze. We're gonna really squeeze out these bears, whoever is bearish, and then we're gonna start rolling. We're gonna start having a rolling top, and that's based upon the current market structure that we're in. We're on the weekly, we're bearish. Usually the bigger time frames win, and at this point things still don't look good, and we're going to go over that with the macro. But based on how things work with liquidity and movement of price, they like to purge liquidity, and these blue boxes are representation of liquidity of people who are bearish or short. That it will start. The market will start collecting a whole lot of money. It's almost like vacuums of black holes whenever it enters these areas, because then it starts sucking up a whole lot of energy and money when it enters these things, because price is that powerful. It as it moves, it charges. And it's kind of just a weird kind of concept, but especially when it goes in these zones. And usually when it goes in these zones and it purchases liquidity and on a stop hunt and it comes back, it's charged up to go in the opposite direction. So if it were to purge these bears, it's going to want to come back and go stronger to the downside. That's kind of just the idea of it. They call it in smart money concepts like Judas swing, but that's the essence of it. I have put some kind of H1 range here, hourly range, and it's a little bit of an idea of where we expect price to go. We expect price to come down into here, roughly, or spike below the last week low, really squeeze it really hard, collect a lot of demand in these lower wicks, and then go up higher so it can purge those liquidity zones. As you saw back here, let's get to the one we were last using. As you saw here on the H4, there is no real bullish order blocks to grab liquidity down here. So it makes sense. There's an incentive to want to push price up here, is because there's a whole lot of liquidity that the banks or whoever is moving the market can grab to make a position, and most likely the position would be to the downside. Sorry for you bulls out there, just because that's just the high time frame sentiment. If you were not aware, then that's kind of just something you got to be aware about. And once we purge that H4 liquidity, we basically hit the high end of this moving average channel, which basically is a resistance. And the weekly bears are intact until we close above this level, which looks like it's kind of ridiculous to get to. Now, the fundamentals are important. because it kind of illustrates like the narrative. You know, there's a couple narratives out there. There's the narrative that the feds did too much, and because they did too much, they're in danger. They're endangering the market and the economy, and because of that, they're less likely to continue hiking. And that's like where would this is kind of, you got people on both sides of the fence, like, the market's too hard, or like you can't predict it, and this and that. First of all, it doesn't make sense because of that narrative of that the Fed did too much, and this means that they're going to back off. That's it's not necessarily true, because usually whenever that is true, the Fed has already made that action or announced their decision of what they're going to do. And in 2020, it was pretty evident. They were saying they made an announcement, hey, this is what we're doing, and blah, blah, blah. And that was it. There was kind of no question about it. Here, we kind of have a question. We have no idea. The Fed didn't announce that they were going to stop. And all of a sudden, now you think they're going to stop? It doesn't make sense. Like, think about 2020. They didn't announce that they were stopping. They were announcing they were going to do QE, or they were going to do whatever was in their power to extreme circumstances to help help the economy under these extreme circumstances. Boom. That was like the proof and confirmation that you needed to really go risk on. Here, there is no message from the Fed saying, hey, we see that we've done too much, and we're afraid about the economy, that it's going to get ruined, and we're going to stop. There is nothing like that. And it's right now a speculation that that will be the case. And that's the problem. The problem is there's, I guess, along with the narrative, I like to call it the banks manipulating the market to get liquidity so then they could short the market. But everybody else that's not the banks puts this narrative together that the rate hikes are priced in, and now it's time to have higher highs. Like, just see how weird that is? It doesn't, these narratives are dangerous. And that's why market structure makes so much sense, because at least you can tell when it's no man's land and that there is indefinite. When it's these narratives, you don't even know if the narrative is no man's land or if it's unconfirmed. You have no idea, because it's built upon ideas like priced in. Like you can't confirm that. Someone who's fundamentally now becoming a technical, being able to define like an event, it's just too weird. So here's some fundamentals. This is where we're at on the rate hikes. 3.08. This is the 30-day forward yield contract. We're at 4.98. So we could take this formula. We could do Fed funds minus, let's see, we want to do a formula. We're going to do this minus bracket 100 minus ZQJ. There we go. And then end bracket. And we'll pull that all the way up. And then this is basically a measurement of how much is left to go based upon the 30-day Fed funds rate. And we could even, pick the 2-year if we wanted. So this is, we're negative. Basically, we're basically saying the Fed has to hike rates about 1.9 points. It still has a lot to go before we're at zero. We need to, I guess, put a line at zero where they're basically the same. Okay. So, and I mean, if you wanted to do the 2 year, we could. So US 02. Okay. Minus Fed funds. So we could do the opposite. We could do Fed funds minus the 2 year. And this is gonna still be negative with that formula. Yeah, as you can tell, I just decided to do this. So we have to go through this process, through this scrolling. Okay, so if it's not 1.9 negative on where the Fed has to make up hike rates 1.9 points, or yeah, 1.9 points, they still, if we were to do by the 2 year, it would be 1.45 points. So have we still have some more rate hikes. Like whether you take the 30-day forward yield, or you take the 2 year, or you take the year dollar futures, year dollar futures says at on the peak here 5.31. So that 5.31 minus 3.08, yeah, that's like roughly, if we were to be exact, negative 2.23. So, like, the whole narratives that are out there, you really have to take with a grain of salt, with the priced in, and the bottom is in. Like, I don't know who these people are who are saying these things, but it's interesting that they might have that idea, because it's so juxtaposed to multiple points of context. When you take the Fed funds rate, you take the 2 year, you take the forward yield, the 30-day, you take the year dollar futures, and what it's saying, that's 4 points. I think that's 4 points. We'll call that 3. 3 points, the 30-day yield, the 2 year, and the Eurodollar futures. That's 3 points that are saying we still got a couple more left. So, I don't know. And yes, they could all be wrong too. But at the same time, I'm just saying, you want to go where the probability is higher. And the probability is higher to where we still got a couple more left. And then we got the yield curve inverted. We're at 52% inverted. That's important, because the higher inversion this goes, it means that people are seeking safety and liquidity, safe and liquid. And as far as something happening this year, like, I think there's going to be a dip, just because that's what liquidity is saying. Liquidity. So what do I mean by that? I mean, we can do off the weekly one right here. Turn on the order block, and this is all I need to see. So just from the same principle of the H4, we have the weekly, and there's a nice weekly bearish order, was a bullish order block, because it's down here. So these are where the bulls are. It's demand, and then these are where the bears are. This is supply, and we could either break up above here, or we can go down here and purge this block. I'm saying we're gonna come down here and purge this block down here, and that's based upon the probability that this high time frame of the weekly is going to hold until we reach there. That is the thesis and premise of what I'm saying. I'm saying that there's liquidity down here, and it's a magnet, and it's going to want to draw price down here. And right now, we're kind of in this chop because of all the confusion and the narratives that are out there about priced in, not priced in. They're going to stop hiking. They're not going to stop. This is like schizophrenic right here with the ping ponging of all the up and down. But just to bring some clarity to the issue, this is what I'm saying. I'm saying that in order to go higher, we have to purge this liquidity. We have to purge the order block on the weekly, at least going to 3,200 before we can head higher. And also have a market structure break to the upside. And that line will slowly, right here, will slowly come down. But that will only come down if we go down or if we go sideways for a long time. But I'm betting we go down before we go sideways. So, fundamentally, we went through the Fed funds and the whole rate hike issue, and then real rates. This is I don't know what real rates. Real rates have to do with gold, and this is suggesting it broke out on the quarterly, and it's retesting where it broke out. It broke out above these highs here, and it's currently retesting it. And if this the fact that it's holding week over week right there is suggesting weakness in gold. Period. That's it. That's the main reason why that's there. Why that's there in my watch list. All right. Reverse repo. So we're going to take a look at the banks. The banks are scared. If they were scared in 2019, they're really scared now. 2020 was the COVID nuke. 2022, I don't know what's coming, but banks are safe and liquid. And then this is like degrees of reverse repo. So they are currently, there was a negative, they were paying a premium for reverse repo over the secured financing rate. Right now, it looks like it's zero. So I don't know what that means entirely, but when they were paying a premium, it meant like things were pretty bad. The 10-year break even minus reverse repo is saying that banks are paying a premium to do reverse repo over the 10-year break even. So that's interesting that the bank would want to do reverse repo over the 10-year bond treasury rate. That's interesting because you would think the 10-year is safe and liquid. But obviously, the banks think the reverse repo is more pristine, it is more superior in its safety and its liquidity. And then Euro USD, this is the dollar inverted, the Dixie inverted. And so far, it's not looking good for the euro. The weaker the euro gets, the worse it is for trade. And if all these dollars are on euro dollar futures or offshore contracts, and the euro continues to weaken, the less likely those parties that have those derivatives of the dollar are less likely to transact and trade. And that means that liquidity will freeze up. And we will see recessions outside the United States before they reach to the United States. But that's a reason to keep an eye on Europe. Right now we've seen with China and how bad things are going there, how bad things are happening with Japan, the food shortages, the uprisings in other countries, and we could see those waves and ripples and just how it's affecting those economies and trade, and then making its way to the United States. And that's why we watch the euro and the U.S. dollar, because it's important for trade and it's important for liquidity. And just to see how much people are we if we're in a dollar shortage, and based upon the Treasury, the reverse repo, and Eurodollar futures, it does in the dollar. It looks like we're in a dollar shortage. Now, the ANFCI annual adjusted national financial conditions index. It's saying it measures three things: leverage, risk, and credit. And it's saying there's too much leverage, not enough credit, too much risk. And because of that, this index is elevated, and we're at risk for lack of liquidity and possible breaking. This is the consumer side. The consumer sentiment, it's low. It hasn't really moved a whole lot, but just know that consumer sentiment is weak. This is the business side. Production minus inventory. If it's low, that means that there is high inventory, low production. And for a business to have high inventory means they're not selling enough. And low production means that they're having a hard time keeping people employed. Instead, they have to let them go. And we could tell how sick things are by this gauge as well with the businesses. This is the Treasury's 3-month, 10-year. It has inverted, I think Thursday or Friday of last week, and it's really showing. I think this is a little bit delayed on this feed, but we're inverted. So I think it says like at least a year. I think it's like 6 to 18 months from when it inverts a recession. So we're gonna see when that comes. So stay tuned. 5-year 30, it's inverted. 2-year 10-year, the famous 2 and 10-year, inverted. Now here is the thing, along with the stocks that are holding up the market. It's the credit spreads. We can dial this down. I mean, it looks very noisy and just complicated. I think it's better on the monthly, actually. Let's get rid of this. So roughly, it looks like this line that was drawn in right there is holding as resistance in some way. And it looks like maybe I don't know if it's like how long it takes to determine if it's rejected or not, but it looks like we're at a decision point. It does look like we're at resistance, and it's making a decision, and it happens to be that wick low. But once it gets rejected, we will know about it through alerts, and we're gonna go lower. So this is the basically junk credit on the corporate side and the high yield growth, and this is the long-term corporate debt, and it's not as excited to try and pump up just because it's like, why even bother? Like, it's already decided. Like, come on, we're going down. That's kind of what I see. I mean, we could just based upon what I'm looking at, like resistance, and I don't know, it's broken below, and we're pretty close to the 2020 nuke low of this credit spread. It just looks weak. And obviously, if you were to wait until the close, we got 1 month and 29 days on both the 6-month and the quarterly. But on the quarterly, it doesn't look good. To get a faster idea of what's happening, you go down to the monthly and weekly. And just looking at the monthly, I mean, we're at resistance right here, and it's pulling back. And it's about if it gets rejected here or not. That's pretty much it. Lumber versus gold. So basically growth versus safety. It's strong towards safety against lumber. When it closed below here in 2018, we stayed low, and then we basically nuked on 2020. And we got a similar thing going. We are doing almost the exact same pattern that we did in 2018, but this is 2022. So I don't know how much longer it takes to squeeze until we drop below, but this is basically saying that growth is something that's in low supply right now. Base metals versus precious metals, basically growth versus safety. It's caught on that moving average channel high. It's just having a hard time seeing growth. It wants to see growth in the future, but it can't. It just can't see growth. Whether it's lumber versus gold, base metals versus precious metals, treasury yield inversions, Eurodollar for Euro USD, or reverse repo. No one, or even consumer sentiment, or inventory versus production. No one can see growth. No one. Except maybe the high yield growth credit spread and junk bonds versus TLT. These are the only things that are really holding up the market. And if we were to talk about the sectors, obviously that would be energy, which we're going to get to. And just to satisfy you, there is what's really holding up the market. But in terms of liquidity, in terms of like fundamentals and liquidity, it's the credit spreads and junk corporate bonds. But we're waiting for it to spike into here, get overbought, and get reversed. A reversal put in, market maker model, or Judas swing kind of thing, deviation and breakdown. But I'm kind of been saying this for, I don't know, I guess a month already for the junk corporate bonds, but I don't know. I'm thinking this is the range where these are the highs that really put in the swing failure pattern before we come back down. Before we get weakness in junk corporate bonds. Move index is the fear bond index, and the bonds are afraid. 60-40 failure of 60-40 portfolio. And with this move index being so high, it makes sense. I'm kind of curious to look at TLT, and I don't know. It looks like it's picking up a little bit, but I guess it hit this demand, but I think I don't know. We might go lower. I'm thinking we might go lower still, and I think it's the reason why the move index looks the way it does. Like, we're near the COVID nuke high on the move index, and I think it's still going to get worse on this TLT because the outlook looks that bad. And it's not about right now, it's about what's coming. And if I were to talk about just kind of my findings on the Eurodollar futures on just the big time frame, let's see. And it's this thing right here. So this is like the big macro cycle. So there's we could see based on the Eurodollar futures when it's inverted. Here we can see the macro version of when it's inverted with these long 10 to 20, 16 to 17 year time horizons of the curve. And this is akin to Ray Dalio's long-term debt cycle. And basically the green area is when it looks like a pension plan, when we expect growth. And right now, this is where we are, the present. We're outside the green. We're about to hit the peak. And basically, we've had a couple of recessions at the peak. We've had one in 1980. We had one at this peak in 1974. The 2000 was a little bit outside the peak, like halfway up. At the peak here, on this peak was 2007. 2020 was a little bit in this trough here. It makes sense. Like if we were to expect like some kind of inversion, it looks like it's inverted right here on the curve. But usually around the peaks or this whole downswing is when I expect fragility. The most ever recessions we've had in this non-green zone was 4 recessions, and that was, it's not on here, but 1974, 1980, 1982, 1990. 1, 2, 3, 4. So we just began the non-green zone, and we have till 2034 when the green zone begins. So the way I look at this is that this is a period of fragility and tight credit, with periods and spurts of monetary intervention that could create growth. But during this time is a good time to really knuckle down and stockpile. And that means really putting in concentrated amounts at low points of the markets and just really saving up money for those recessions. Because if we were to get a lot of recessions if we were to get 4, let's say it's in the 70s, we're in 1970 to 1990, that window. And I just told you, like, hey, just save up a ton of money. Whenever we hit like a really depressed point in the market, you buy. And you did that 4 times. You would be sitting pretty. So basically, this is that time. This is the time where it's possible to have 4 recessions within 16, 17 years. And during that time, the best thing to do is work your butt off, save a lot of money for those stockpiling events of when the market's depressed. Boom. That's it. And then XLY versus XLP, discretionary versus consumer staples. Consumer is afraid. They're not spending. If they were, we would be seeing it staying above this blue moving average channel, especially this one. Right now, we're having trouble right here. We're having trouble staying above this moving average channel on the 6 month, on the low 10 low 6 month. And the last time we were below it was 07 to 09, and then we broke out back above it, and we've been above it ever since. Now we're below it. So basically, the market's weak, it's fragile, and consumers are afraid, banks are afraid, businesses can't get anything sold. They're having trouble getting rid of their inventory. So that's the fundamentals. And if we were to go into more fundamentals, we could. I got stuff for real estate. We could look at that kind of fundamentals. So, and I think we went over the Eurodollar futures basically. 2020, we hit the peak in March 2023. We're expecting some kind of bottoming around 2024, 2026. So that's kind of just what that is about. And I'm going to do a piece on comparing Jeffrey Snyder compared to Eric from EBP Research. They almost come to the same conclusion, but starting at different points and with different indicators. So it's really interesting, and I wanted to kind of break that down in a different video. But that's kind of what brings us into Eric's research, starting with mortgage rates, new homes, new single-family homes sold, building permits, mortgage-backed applications. What is the rest? Existing home sales, new one-family houses sold, housing starts, housing building permits, construction total spending, the manufacturing orders, supplier deliveries, purchasing managers index, PMI, the average weekly hours of all employees, construction, manufacturing, private residential fixed investment, real personal consumption expenditures, all non-farm, pay all the way down to income. So that's kind of Eric's research, but that's the other fundamentals. But going down from candles at a glance, we're looking at sectors. Energy, healthcare, industrials are the strongest, with communications, discretionary, utilities, and tech the weakest. What's weird is utilities, being, if it's such a defensive time, utilities would be top 4, top 5. It's not. It's down with real estate, tech, and discretionary and communication. So something's off. Even materials is not really strong. So defensives are trying to put in the work, but something's still off. That's kind of what that's saying. And then we look at the market overview. The Dow's the highest, Dow's the strongest. 10 years, the second strongest, and the Wilshire is the third strongest. And then oil is the fourth strongest. VIX is the weakest. Gold and tech are the bottom 3. So it's really weird. Like gold's not doing its job and looks really weird in the market. Is there inflation? Is there not inflation? Things like that. Like, why isn't the gold doing its job with inflation? This is the indexes, like the Dow small cap energy. I think that's VLE. I'm not 100% sure. I think it's like airlines maybe. Bottom 3, S&P 500, Dow, utilities, and NASDAQ. And then maybe we'll take a look at crypto really quick. Dodge coin is in front, big gains, a lot of strength. BNB right behind it. ETH third strongest, and then weakest would be XLM, USDT, and XRP. But that's pretty much it. The state of the market. Basically, we got a big event tomorrow, FOMC. My expectation is that if we were to go higher to grab that liquidity, we would go into demand, and then we would launch up into it like a trampoline. We would jump down into the trampoline in order to get the force to launch itself up into the ceiling. And then that would cause a cascade into some effects of gathering all these bears to really push the market down. Whether in a slow way or a fast way, I don't really care. I just want it to go where I want it to go as a target, and that's the spread. But that's kind of what I see in the market. As far as like alpha, right now, it's just 3% to the upside. That's it. Like, that's the only alpha. And until we reach that 3% or 4,000 on the S&P 500, whichever comes first, that it's long and then it's short, and then until we reach 3,200 on the short side, and that's the alpha. And shorting strength, energy, real estate, gold, like all those things that either trend continuing for weakness or that are in strength that could reverse, that are volatile, have a high beta, that could come down pretty hard. And then, of course, shorting the index. But that's pretty much it. So thanks for watching. See you next. And then on a side note, I don't think this really matters a whole lot. I mean, um, I guess if you were to say something, um, I mean, no, it's looking bullish. That's it. So, looking like maybe we could go up. I don't know, but maybe up to here, or we continue past there. I don't know. But thanks for watching. See you in the next video. Oh, and then maybe timing solutions. I don't know. I'm thinking I'll save these for another time.